Good morning and a warm welcome to the Industrial and Logistics webinar hosted by Colliers. We've got a packed agenda today, and the agenda will be as follows. We're going to do an open market presentation, which includes investment market, which will be followed by a panel discussion. We're very lucky today. We have a great panel. We have Kevin Say from DHL Corporate Real Estate, Matthew Webb, who has taken the place of Hilary Witt. A big thanks to you, Matthew, for coming in at short notice. Myself and Andrea Ferranti. A big thanks goes to Liza Helps from Logistics Manager, who's going to moderate the panel today. The slight difference to our webinar today is we're going to have a live questions Q&A, which means anyone in the audience can ask the Industrial Logistics team any questions via the Q&A or chat. On that note, I'm going to hand you over to Andrea to start our presentation.
Thank you very much, Len, for the introduction. So before we start things off, I'd like to say that if you're interested, of course, after our webinar, please check our social media channels and website to remain up to date with what we do and access our freely available research content. So without any further ado, let's check the latest online sales data and how this is fueling appetite for industrial space. So during the different lockdowns last year, online sales of total retail sales in the UK reached monthly peaks of 37% in 2 different months. But following the reopening of the high street, these figures understandably contracted. There seems to be a clear step change, however, in consumer behavior, which is resulting in above trends figures. So this data actually for July and August reached 25.5% for 2 consecutive months, suggesting that this could be potentially the new norm going forward. So it'd be interesting to see how these figures is developing over the next few months. On the right-hand side here, thanks to my colleagues in research, you can see a chart showing a clear positive correlation between the strength of online sales and occupier demand. In here, annual take-up is plotted against online retail sales, demonstrating a significant linear fit with an R-squared of 0.7. So the closer R-squared is to 1, the stronger is the relationship between 2 variables. So in this case, simplistically, meaning that the more we shop online, the greater is demand for logistics space. Therefore, we continue to predict strong demand for warehouse space as consumer appetite for land deliveries doesn't seem to dissipate. Now it's time to actually look at the latest take-up activity. And occupier demand is as strong as ever. Take-up for the 3rd quarter topped 11 million square foot, resulting in a year-to-date take-up of 33 million square foot for units under 1,000 square foot plus. This is actually 11% below the record levels seen last year over the first 3 quarters of 2020, which is to be expected given what happened in 2020 as occupiers were dealing with different lockdowns and trying to bolster their supply chain capability. But as highlighted by the blue chart here, demand for grade A space has also been dominant factor for, this year to the end of Q3 2021. Last year, occupier took circa 50 million square foot of space, and a third of this space was grade A space, was new space, design and build and specs. So this also been happening over the past few years, but the key thing here is that due to the lack of available space and occupiers need to fulfill their requirement SIP, we've seen a major uptick for take-up on speculatively developed units. So this share reached 37% this year to the end of Q3 2021. So Len, I'd like to ask your opinion on this. So developers have been able to capitalize on this absolute lack of supply. So what are your thoughts on this?
Thanks, Andrea. Yes, I think the first thing is obviously the chart is self-explanatory, but one of the things which I think sort of stands out to me is design and build have always been around 50% of the total share of the take-up in the market. That's dropped to about 35%, and we don't see that changing over the next couple of years. I think the other thing to say is, as you said, the market is incredibly buoyant at the moment, and we're seeing a number of our developer and fund clients that the opportunity is very rare for space, and a lot of them are finding that their speculative program, they're letting the units prior to PC. This obviously is great for the developer and the funds who have very low voids. Generally, when we're speaking to them, their void rate is between 1% and 3%. The downside of that, if you're an occupier looking for space currently at the moment in the market, it's very challenging, not only with the lack of space, but with rents going up almost on a weekly basis. This is a real challenge for occupiers. Back to you, Andrea.
Thanks again, Len. So let's now look at take-up by deals counts and size band. So as clearly highlighted by this chart, the first thing that I'd like to highlight actually is the significant increase in take-up activity for unit sized 500,000 square foot plus, as occupiers look to upsize and in some instances consolidate their operation while increasing their online fulfillment capacity. Having said that, it is quite difficult to spot a clear trend here across the different unit sizes, as demand has been strong across them all since 2018, particularly over 2020 and 2021. So if we look at the chart in more details, the strong momentum has carried over from last year for unit size between 100,000 to 200,000 square foot, with also demand for unit size between 300 and 400,000 square foot, showing a strong reading of 24 units let over the first 3 quarters of this year versus 19 for the full 2020. So let's now look at where we are in terms of supply. So on the left-hand side, you are shown with historical current supply by grade, while on the right-hand side, we're looking at spec development and 2022 announced, actually, I would say scheduled deliveries. So current supply in Q3 2021 stands at circa 20 million square foot, which is the lowest ever seen in the sector, and a decline of 38% when compared to Q3 last year. So this is an astonishing number. The level of supply might potentially hamper future activity, as our Q3 data also includes spec space scheduled for completion by the end of this year. Therefore, pre-lets are more likely to satisfy current and future demand. So occupiers will need to be planning well in advance if they have any chance to secure any new space. But if we look at the two charts side by side here, the market has absorbed a significant amount of grade A space, as the development market doesn't seem to keep up with this insatiable occupier demand. By the end of this year, the market will have seen 11 million square foot of new space delivered speculatively. However, as you can see by on the light blue chart, circa 7 million square foot of this space has either let or is under offer, hence suggesting that supply will remain suppressed over the next 12 months at least. 2022, there is circa 15 million square foot of space scheduled for completion. So assuming demand remains elevated, which is our current base case scenario, we do not expect this to be a problem at all for the sector. So, but actually, it is a highly welcome boost to the supply figure, so nothing to worry about. I'm sure you are quite interested to see what's happening in 2022. So here I'm showing a table which analyzes new supply by size, band, and number of units, which are currently scheduled for completion next year. So I'm not gonna dwell too much on this, but it seems to be a very good mix of unit sizes which are scheduled for completion next year. But what does it all mean for rental growth? So the market is clearly experiencing a supply crunch, and this is prompting a phenomenal rental growth across the UK. These are the latest MSCI rental growth data, and I'm here to highlight what you all experienced in the market over the past couple of years at least. So with occupiers seeing rents increasing on a weekly basis, sometimes I would say, in certain markets where there is a very little availability. So just to briefly mention a couple of figures here, London rents have grown by nearly 7%, with Southeast assets seeing rental increases to the tune of 4.8% and 5.5%. However, I'd like to caveat these figures, as here we are looking at average rental growth for all grades, all sizes, as reported by the MSCI. There have been some instances where rents have grown by about, between 10 to 30% in certain schemes, particularly in London and the Southeast. So Len, is there anything that you'd like to add as you and our team been on the ground acting on behalf of investors, occupiers?
Thank you, Andrea. As we've said, the first thing is obviously void rates are so low. We're finding that we're on a number of schemes across the UK, not just in the Southeast and London, but we are finding when we have multiple units to let on a park or a mid-box multi-let unit scheme, the differential between the first letting and the last letting when it actually happens, the rents, as you were saying, in some locations are going up as much as 30%. Those rents are generally in the Southeast and London when it's at the top end of that. But we are seeing across the UK and other prime locations, such as the Midlands, Northwest, Northeast and Southwest, where rents are substantially going up on the second or the last letting we have on a scheme compared to the first letting. Obviously, this is a challenge again for occupiers because, as I said, due to the phenomenal market we're in, it's great if you're a landlord or developer, but obviously more challenging for an occupier. I mean, we've been doing this 35 years, myself and some of my contemporaries, and this is the first real time we've seen rental growth happening. In other buoyant markets, generally what's pushed the market forward is the compression of the yields, but this time it's real rental growth and yield compression. From our perspective, we don't see this changing anytime shortly for the things Andrea's spoken about already. So the challenges ahead are, I think, getting speculative accommodation out of the ground. Andrea's going to talk about that shortly, which is coming out in 2022. And also then the challenge from the occupiers is obviously trying to get hold of this stock in a very competitive market on terms which allows their businesses to flourish. Back to you, Andrea.
Thank you very much, Len. Yeah, let's now look at what's happening in the investment market. So the strong investor appetite is driving industrial total returns to new levels, only seen in June 2009 when the market was initially starting to potentially recover from the global financial crisis. So according to the latest MSCI data for Q2 2021, the industrial sector outperformed all the other sectors and posted 22.6 total return as investors pile in to secure industrial assets. So for those of you interested, Q3 data will be available in a few weeks, so feel free to drop me a note and we can discuss the latest trends and figures. On the right-hand side here, you actually see investment volumes. So investment volumes reached a new record. So provisional data for the first 3 quarters of 2021 show more than 11 billion turnover. This is actually higher than the previous record, I would say annual record seen in 2017, as buyers are drawn in by strong rental growth and rental growth prospects, as well as a yield compression. But before we move on to our panel discussion, we have our last slide here. So where are yields now? We are showing a historical yield gap between average industrial net initial yield over the 10-year UK gilts, and the average UK net initial yield stands at 3.9% for all industrial across all sizes, as reported by the MSCI, which is at an historical low level. We expect further mild yield compression, particularly when Q3 data will be released in a couple of weeks or so, as the yield gap seems to make industrial assets highly attractive here. However, I don't want to sound not as positive as you would expect, but there are some downside risks, as the Bank of England have signaled that the MPC committee members are more likely to pull the trigger for the first rate rise this year due to a more persistent than expected inflationary pressure. This is something to be mindful of. However, as seen in historical data, property yields have been much more correlated to economic growth rather than marginal increases in base rates. So this is something to be mindful of, as I said, but we're still expecting further mild yield compression due to the strong appetite for industrial assets. So on this note, I'd like to hand you back to actually Liza Help for our panel discussion. Thank you very much.
Hi, thank you, Andrea. Thank you, Len. Lot of food for thought there. I think one of the things I found most interesting right back at the beginning there was about online sales. So with that in mind, we have some polling questions, and the first polling question should hopefully come up on the screen now, if you'd like to sort of press your buttons on that one. So going back to sort of the panelists, I don't know, sorry, that's gone right away. Going back to the panelists, really to ask them that very same question. Do we think that the share of online sales at 25.5%, could this be the new norm? I don't know, Kevin.
Good morning, everyone. Yes, basically, I think the way we're seeing our customers in the 3PL market, the way they're developing their warehouses, they have obviously assumed that they will be doing a lot more online business. We're seeing warehouses being targeted to be omni-channel, which includes very much an e-com solution. And we are also seeing parts of our business adapting to cater for not just the big customers, but smaller entrepreneurial businesses where they can actually go in and buy the services of us to do for smaller players as well. So, for example, if a company starts to get to a size where they need some support, then they will come to one of our warehouses where we would say, well, we will deliver a package for you to supply your customers anywhere in the world. And obviously that impacts on where we situate our facilities to be close to the parcel hubs, which in the Midlands, there's 4 of them at least. But it's all showing the view that online is very much here to stay.
What does that sort of mean in terms of your sort of expansion plans? Do you feel you're going to have to do more based on that online?
Yeah, very much so. I think we are aware that e-commerce is very much involved, not only on the 3PL business, but very much in our 2 domestic parcels companies. We've got the domestic parcel company that's growing exponentially, and our international business is still very, very strong. So from that point of view, I don't think it's going anywhere. We have got requirements out for upgrading a lot of our parcels facilities because they are not big enough for the growth that we anticipate now at present and going forward. So, you know, I think all the parcels companies are, if they're not upgrading their current facilities, are looking for infill sites to meet the demand, and it's critically got to be close to where the customers are, i.e. the chimney pots. So we don't just talk about the 100,000, we also got to look about the smaller 50 to 100,000, where I think there is a strong demand there from parcels companies as well. We're one of them, there'll be our competitors will be in the same position.
Let's just see, we've got the poll results in now. There we go. I think most people agreeing that this could definitely be the new norm going forward. One of the things that this is showing us very, very clearly as people want to upgrade and have more space is there is a huge demand being put on. And what we're seeing, my brain's gone dead. Sort of what we're seeing is there's putting lots more pressure on occupiers. How does that sort of show itself in the market generally? Sort of Len?
Thanks, Liza. I think, obviously, as Kevin said, I'd echo everything Kevin says. You know, it's here to stay. I think the question is, where is it going to go to, the online sales? I mean, everyone's got their view on it. I think our in-house view is going to end up somewhere between sort of, you know, 40 and 50%. Where it's going to go and how that impacts the market. One of the stats my illustrious colleague Andrea was talking about was on top of the additional supply, the take up over the next 4 years because of the e-commerce going forward. We're going to need an additional 50 million square feet of warehousing space over the next 4 years. And because of this, the impact it's going to have on the market is there's constantly a shortage of space, which obviously plays into the hands of the developers and funds, but it's going to make it really challenging for, you know, people like Kevin to find grade A space. That said, I think the developers are keen to try and put more spec into the market. But if you work in a development company or on the fund side when you're out buying sites, you all know how very difficult it is to get these sites through planning and how long it takes to get them sort of up and ready for development. So I think, you know, where it's at, Liza, it's going to be a challenge for occupiers over the next 2 to 4 years to find grade A accommodation. I know we haven't spoken about it, but the other challenge for them is as well, obviously, the ESGs going forward, which obviously a very important part of what space they take. And I think it's a big drive for all the major companies to make sure the space they are taking is in line with their ESG credentials going forward.
I mean, added into that one, I think I'm going to be moving swiftly on. Added into that sort of problem, obviously, right now we have a sort of construction crisis. And I think there's another polling question on that one. How the increases in construction material costs impact the delivery of the schemes coming forward in 2022. If anyone would like to press the button on that, but then sort of coming back sort of to that, how much of that is a concern, Kevin, for you, knowing that you want to expand and that this might also cause problems?
Well, we're in the same boat as most developers. We're looking at our costs very closely. Some of our fit outs are very, very substantial, and these costs that are coming through are eye-wateringly painful in certain projects, especially when you talk about automation and the level of investment that goes into some of the bigger warehouses. We've found that very, very difficult this year, especially with steel, which I think probably in echoing quite a few construction people who are sitting there saying 1 week to the next, you don't know what the cost of the steel tonnage will be, and it makes it very difficult to plan going forward. The other constraint, I think, is the demand, and the fact that there is more demand than we can actually supply, which is meaning it's not just construction costs, it's actually the ability to build. But from our point of view, when some of our fit outs are very substantial, we find that very, very painful. But we're all in the same boat in some respects. But yeah, it's not a happy place to be just now with the cost of not only just the materials, it's actually the workforce, and actually finding the workforce in some respects, because quite a few have obviously left the country, and they were a valued resource which we used, and I think that's causing pain for everyone in the sector.
Len, do you think this is going to sort of continue, or and is this a long-term thing?
I'm hoping it won't be a long-term thing. I mean, I've spoken to a number of contractors, developers, and they're all hoping it's going to sort of ease its way out over the next sort of 12 to 24 months. But that said, at the moment, the challenges they've got are working with people like Kevin, where they have got delays, they have got issues with getting the materials over. But I think just speaking to key sort of companies within the industry, I think we're going to see the increases sort of sadly remain in the construction industry going forward for the foreseeable future. But I do think it will ease the pressure with actually getting materials. With regards to Kevin's second point about personnel and staff, I think that's going to be, a challenge going forward. But I think it will ease with regards to the delays we're experiencing. I'm not sure we're going to see necessarily any price reduction on the construction prices, which we're now sort of seeing, which, have gone up as much as 20%. And, I think there's a lot of pressure where people are looking at the contractors, but actually they are generally just passing on the costs which they're receiving from their suppliers on the goods. So it all gets back to the classic supply chain. But I do think prices are here to remain, but I do think the issues with the supply chain for materials will ease up over the next 12 to 18 months.
Well, that's good to hear that they might be easing up. Andrea, we were talking about the amount of speculative development being planned to come through in 2022. Is this going to cause further delays? Might this prevent that amount of space being delivered?
Thanks, Liza. I think there might be some marginal delays, but developers have demonstrated the efficiency, to be honest. I mean, in 2021, this year, we had similar issues, of course, not as bad as we're currently experiencing now towards the end of 2021. And we've seen just few schemes being delayed. And as I mentioned, this year we will have seen 11 million square foot of space being delivered. Next year, a little bit more. So it's going to be a challenge for the sector, but I think it will have a marginal effect. The real effect could potentially be on pricing. So we're seeing land values increasing dramatically. Our rents map shows that on average, land values actually increased by 40% for the 12 months to the end of July. We're going to be updating our rents map data and land value data in January. And I'm sure we will see even more increases there as developers are actually trying to push the envelope sometime and with regards to rents being agreed, and their expected rental growth is factored in to be able to purchase lands at higher prices. But what I'd like to expand on, Eliza, if you would allow me, is the initial question, which ties in really well with this one, with regards to extra demand for warehouse space. And also Len mentioned that we've been saying that the sector will need 50 million square foot extra space to satisfy this extra demand. This actually been seen in 2020 and 2021. Prior to 2020, the 5-year annual average take-up was around 33 million square foot. And 2020 saw 50 million square foot. Now we have 33 million square foot with 3 months to go. So what we should be focusing on is the frame of reference has changed completely. So now more online sales, higher cost, higher rents, supply chain disruption. So the logistics sector is being challenged dramatically, but of course we'll be able to adjust as demonstrated over the past 20 or 30 years. So these are the major challenges, and I'm sure the market will be able to deliver the space needed. However, it'll be completely different to what it was 10 years ago or 5 years ago. Rents will be higher, yields will be sharp, and occupiers will be challenged even more with margins being eroded because of supply chain issues coming from China particularly, and the cost of construction materials.
Well, if we can have a quick look at the poll results on that second question. Are they there? Hopefully not very far. Yeah, the substantial impact. And as we've seen, that's definitely happened. And we're seeing that reflected in rents, just yet another thing to push those rents on. I'm going to bring in Matt. from Colliers. With these sort of rents sort of going up, and sort of average, I think I heard, was 26% across the UK since April 2015, when we had the last rates review. What does that mean for what I call that hidden cost rates going forward for occupiers?
Yes, thank you, Liza. Yes, that's a good question. And I think just to put things into context, so the current situation that people are paying rates on, the valuation date is the 1st of April 2015. And the proposed date for the revaluation is the 1st of April this year. And obviously today we've already looked at the trends across the country, which are very much upward in rental values over that period. So we have done some analysis in terms of locations throughout the UK and what that might mean in terms of RV growth, and then ultimately what that means to the ratepayers. So on average across the UK, if the valuation office follows the market trends that we believe, then on average it would mean a 30% increase. But that varies dramatically in each market sector within the UK. Actually, interestingly, the Northeast comes out as the highest potential increase, which could be 50%. The lowest potential increase is in Scotland, which could be 20%. And the Southeast, including London, could show a 40% increase. So dramatic increases potentially, assuming the valuation office follows the trends, and that really just follows the market. So it's potentially big increases across the board.
Thank you, Matt. That sounds quite terrifying at the moment. And I'm sure there are other pressures being put onto the supply chain. Kevin, I mean, looking at those pressures as they sort of come in, you know, we've just heard about the rents going up, we have now just heard about the rates. What kind of things are in addition to that are sort of keeping you up at night?
Power, cost of power, investment in our buildings to mitigate our carbon footprint. And clearly we, DHL, are very much on the front foot with regard to trying to reduce our carbon footprint. We've stated that in as a corporate goal on all levels. That's from planes, boats, properties part of that. Which is meaning, as I say, when we look at buildings now, we're looking at the quality of the building compared with regard to its efficiency. So, you know, we're almost getting to the stage where any new building we take, we want a BREEAM excellent standard. And we probably will even invest more on that if we can, if the ability is to do that, to consider advanced options, which may be solar walls, enhanced insulation, because we just see, one, to keep our carbon operational footprint neutral, and that means investing. We also want our landlords to invest, because we will start looking at buildings very closely to see whether what is actually on the table. We have to work with our landlords if the buildings aren't quite there, if it's the right location and it's the right size, what we do forward. That's a cost implication as well, which has to be discussed as part of all negotiations. I think landlords have got to realise that that is the way corporate organisations are pushing. So it's, you know, that's what the customer wants. That's what you've got to start delivering. But that is a cost into our buildings. On a wider sphere, everyone's heard all the problems with regard to labour. That's a big issue as well. But if I'm looking at just from a property point of view, is we've got a directive from our top management that our buildings have got to be a very good standard, including maybe a minimum 18 to 20 items that are almost have to be ticked on taking any new buildings, or even if we take an existing building before we, which is just being built, but is speculatively built, we would then look at what added value have to do that. And it's driving us also to look at our existing portfolio about whether it's fit for purpose. So older buildings will be very heavily scrutinised. about, you know, do we renew the lease if it's not viable to improve it to make it meet our criteria? So there's a lot of change going on in our portfolio as we try to meet the customers' goals, because they are the ones who are pushing us as well as our own agenda. And that's all cost. But as we've all seen with the fact of power and heating, etc., and resource, we want to try and get them costs down as much as possible, because it's getting more expensive. And I don't think that will change. All our electricity is now green. We buy green as a standard, so you know that helps. But going forward, you know, minimum standards that you know, sites have to have electric charging for vehicles, cars, being ready to take solar roofs with solar ready. So if not, have solar panels on it, etc. So there's a whole raft of agenda items that are coming forward, which are putting cost in, but the idea is to actually reduce our cost in the long term. So there is initial investment, but the longer term is to get that cost down and also to mitigate our carbon footprint.
As you said, I mean, trying to get those operational costs down means that you're having to upgrade the buildings. And as we've seen, going back to all the wonderful graphs that Andrea put up there, we're seeing a very big push for grade A space. That in itself, you know, pushes on rent levels, because it would, getting better space, it will demand higher rent levels. And as Matthew has sort of talked about, as we've seen that sort of increase in rents going across, that also pushes on rates. But, you know, property is a secular little beast. And there are ways we can reduce or mitigate those costs. I think, Matthew, you've got some sort of ideas on, especially now on the rate side.
Yes, certainly. Thanks again, Liza. Yeah, I mean, there are a number of ways to mitigate rates in relation to the obvious one is to challenge the valuation, but there's certainly additional ways to look at it. One can look at the way the building is used and the cubic capacity, which is probably not so well known within the market. And that's certainly a way that you can look to mitigate the rates you actually pay by looking at the way the building is being used, not just the full plate, but actually the cubic capacity is certainly something Colliers have looked at with great success to reduce the sort of the rates at that period of time. And I guess that particularly relates to where you have seasonal flows, for example. To be fair, actually at the moment, most warehouses are probably full, but where you have a seasonal flow, for example, at some of the bigger retailers and Tesco's, for example, where at one point in the year, maybe at the beginning of the year, the cubic capacity is fairly low, then there is potentially a way of looking at that and using that to argue for a rates reduction over the period that it's underutilised. So that's one specific way. As I say, at the moment, it's probably not the case because most warehouses are absolutely rammed. But that's certainly one way of looking at it, which may not be known within the market. So,
are there sort of any other ways of sort of challenging the rates, or it's certainly reducing that immediate impact?
No, but I mean, it's probably more to look at what's coming is in relation to the government has changed, will potentially change in legislation going forward. And I think that's going to be more of an interesting discussion point for today, really, if you want to pick up on that now or potentially later. But that's certainly what is coming and the changes which are definitely going to come. It hasn't actually been confirmed yet, but there's certainly been consultation papers out there, so that's really, I think, where the changes are going to be. People are going to need to be far more proactive in the way they deal with these situations going forward. So, do you want me to sort of summarise that now, or?
Yes, please.
Yes. Okay. So, just leading on from what I said earlier, I think we would accept that because of the market trends, values are going to go up, and that at the moment, unless the government changes the goalposts again, that will come into effect on the 1st of April 2023. But the draft list will come out in December next year. And there's really, the way I look at this, again, it's not been formalised yet, but there's 3 key elements to this going forward. The first is really, because we've already talked about the increases. So if you're looking at a 50% increase in your valuation, will that mean the tax you pay from 1st of April 2023, will that mean that you'll suddenly jump straight onto paying that 50% increase? Or is the government going to phase that in through transitional phasing? So are they going to phase in the increase, or are you going to jump straight onto it? That is a question which has not been answered yet. But potentially, if there is no phase-in, 1st of April 2023, you could be, in some instances, looking at a 50% increase in the rates you pay in certain areas. So that's a big question mark. The second question mark is the timeline for actually challenging an increase in the rateable value. At the moment, for example, you can appeal, you can challenge at any point within the six-year period. What the government is proposing is a 6-month window. So, but not 6 months from the 1st of April 2023, 6 months potentially from when the draft list comes into place, which will be December 2022. So you only have 6 months potentially to challenge every assessment in the country. That is a massive change, and it's going to need an awful lot of proactive activity to be able to be in a position to actually deal with that if that comes into effect. And the third difference, or the third change, is the duty. And what I mean by that is at the moment there is no duty for the ratepayer to notify any authority of a change in occupation. And what I mean by that is if you've installed a mezzanine, if you've installed an office within the warehouse, you're under no duty to notify the valuation office or any authority. The proposal is that changes. So if any occupier makes any alteration to a property, it's their duty potentially to notify the tax authorities. And the way that the proposal is that that's to be dealt with is by about an annual return. So effectively, very much like a tax return, any sort of tax return, at the end of the year, the occupier potentially is going to have a duty to produce a tax return which says whether they've made any changes or not. And if they don't identify something, then potentially they will be liable. So those are the 3 dramatic changes which are being proposed. There are more, but I think those are the 3 key ones. And I think the key to it is to be proactive. You've got to be fully aware of what's coming up. You've got to know the market within each sector, and you've got to be fully prepared to actually deal with these things in a proactive way, because there is going to be massive changes. So, and that's really it, I think, from the summary point of view.
Just want to sort of go back to one point. You talked about if you make a change to a warehouse, for example, with a mezzanine, does that mean that if you do that, you could expect them to count that as part of the footplate and as part of the rates as they calculate the rates bill? Does that mean you might have to pay rates on mezzanines as well?
You do. The key difference is at the moment you're on no duty to actually notify anyone that you've made that change. It's really up to the authorities to find that change. The proposal is that you have to notify them on an annual return, and if you have installed a mezzanine which is deemed to be rateable, then yes, exactly that, it will increase the rateable value and increase the rates that you actually pay. So that's a significant difference. It's the duty of the occupier, the ratepayer, to notify. So yes is the answer.
Scary. Again, just sort of looking at on that rates and that mitigation, Len, Andrea, or even Kevin, do you have any sort of thing to add to that on that sort of rates thing and that sort of, I know, almost bombshell that's been hit on that one, Kevin?
My interest will be whether or not, because of the specialisation that's starting to come in the logistics sector, with example processing centres and certain sites becoming e-com centres where there's an awful lot of fit out and mezzanines, etc., whether they will be treated slightly differently to a standard logistics warehouse. Example, if you think about cold stores, a box within a box, they're treated slightly differently and they may be valued differently. And it'll be interesting to see how the valuation office actually approaches that. And that gives me a bit of concern because, you know, you can have a warehouse which has 3 times the footprint of the warehouse because of the mezzanines. And if we're getting up to 15 meters, you can have ground plus 3. And that'll be quite interesting to see whether and how that impacts on the actual rent, because the rent will be based on just the shell building. And then it'll be, well, how do you quantify what those mezzanines are actually worth going forward? And also, you know, I think going forward, there is going to be more automation and specialization in the buildings, which will be a quite extensive investment, and whether they'll still be treated just as plant and equipment. So there's some areas which I think are going to become more pertinent for the valuation office to try and get their heads round, and I think that'll give the rating consultants more work. But I think there's going to be some battles going ahead as they try and protect. Well, hopefully, my rating expert will be protecting my position as much as possible because I don't want to pay any more tax than I have to.
Understandably, again, with all the pressures that are sort of coming down, we don't want to pay more than we have to. In you know, looking at that, what kind of sort of impact could that have on values sort of per se, Matthew?
Well, I think value-wise, Kevin's exactly right. Obviously, the rents are based generally on units taken as they are, pretty much shell units. So that will form the basis of the value as the value effectively. But then any additional works which are carried out to a building could potentially be rateable, and it depends on the nature of those works really, and it's very specific. We talked about mezzanines a minute ago, but mezzanines are generally rateable, even if they're 3-story mezzanines, they still attract value. It's not the same on the 3rd floor as it will be the ground floor. But yes, I'm sure the valuation office will be looking to value every additional element of a building. And it's one of those things, I think, which people struggle to get their heads around, and I do. You improve a building and you actually pay more potentially for improving the building, making it functionally more operational. They charge you more for it. It's going to be a battle for sure, but you can sure the valuation will be looking to add on for any addition that occupiers make. I think the key to all of this is as I said earlier, really, we would come from a situation where you can challenge assessments anytime within a 6 or 7 year period. The key thing about this is now, if the government gets its way, you're only going to have that 6-month window. So you're going to need to be very, very proactive in terms of the advice you get and look at these things far quicker than they've been looked at before. And also in relation to whether there are any changes to buildings, that they are picked up, because, as I said, with an annual return going in, they need to be picked up as they're done effectively. Otherwise, you know, you could well get a backdated situation where you're charged where you know, because you've done works and they're picked up and they're backdated. So yes, hopefully that answers the question.
Lots of things for us to think about onto that one. The other thing that sort of is coming through, which was mentioned again on the investment side, we talked about land. One, we need it to build, but you were talking about sort of land values, Andrea and Len. How is that affecting? How's that impacting on the UK logistics market, Len?
Thanks, Liza. I think the impact it's having on the UK logistics market is predominantly that it has an effect down the line. So, you know, for example, if land values are going up substantially, generally to support the land price you're paying for it, you know, you need to achieve a higher rent, lower yield. And the other issue with it, of course, which you've spoken about and touched on briefly, is construction costs. So all these components which are going into developers and funds who are trying to buy land is making their job quite tricky at the moment, because from every sort of end, they're having to work out, you know, where they can get their profit from. For example, you know, if you recently bought a site and you made assumptions on your build costs and your build costs have gone up 20%, you could be in real trouble. The reality is generally the rental growth is getting you out of that hole. But of course, this does have an impact down the supply chain from a property perspective. I think going forward, land is becoming a more rare commodity. I don't think that's going to change. So I think land prices continue, there's going to be pressure on them, and they'll continue to rise. Hopefully that answers your question, Liza.
It does. I mean, I said with the increase in sort of land prices, we're going to have to use it much more sort of effectively. But one thing that's always fascinated me is, despite all of that, yields, I mean, are at historical sort of lows. What is going on? We've got everything sort of saying we should be sort of backing off, and yet it doesn't seem to be happening. What is really sort of behind that, Len?
The reason is lack of commodity coming to the market. Prime grade A investment stock coming to the market is still quite rare. And the reason for that, which I'm delighted to say, logistics has become, you know, the star asset class. We've only waited sort of 40 years for this to happen, but it is actually the case now. And because of that, most developers and funds, when they've actually developed a site, let it up to good quality tenants on long leases, are generally holding that stock. And because of that, there is less and less stock year on year coming to the market. And because of that, there is a sort of pent up demand for prime grade A stock, to the extent we bid on a number of things recently. And if it's prime, generally, there are at least 2 or 3 rounds of bidding to actually get to selecting a party. And we don't see that changing, you know, whilst logistics is the preferred asset class. I think there's only going to be more pressure on grade A or prime logistics investments from a logistics perspective when they come to the market, where I think there is going to be further yield compression. I don't know, Liza, but maybe I'll hand over to Andrea just for any sort of comments on that.
Yes, Andrea, what are you seeing when you look at this?
So of course, so the first thing to consider is, of course, increase online spending, which is making operators expand their operations. And also, another key thing is, of course, investor appetite is driven by future expected rental growth and also potential yield compression and capital growth. And if you look at what happened during the pandemic, we've seen a demand for warehouses skyrocketing. Potentially, some structural change in the office sector, with people working from home a little bit more, even nowadays. And also the retail sector is transforming itself. So pension funds, UK institutions, and overseas investors have all been trying to get a little bit of action in the industrial sector, trying to rearrange their location in the portfolio. On top of that, we've seen global investors, multi-asset investors, trying to get their money to work in a low rate environment where they couldn't get returns in different asset classes. So the industrial sector found itself in a perfect situation to attract capital globally. And the UK market is a prime market, and we're seeing Asian investors, US investors, all trying to get a piece of action of the UK market. Similarly, we get UK property companies who've been acting very aggressively here with their land holding. So these different factors coming together and made pricing increase dramatically. So if you look at, if you remember the chart that I showed earlier on, so we had total return of 22.6%. That was off charts compared to what the office sector, retail sector, and that sector did. If you also consider the alternative sector, of course, the alternative sector had been performing extremely well up to the beginning of the pandemic. Then, of course, with leisure activity being shut, etc., again, we see certain investors go and trying to get some returns in the industrial sector. Finally, I'm not going to be speaking any further, and the key thing is future expected rental growth. And the industrial sector at the moment is the only sector it's been kind of guaranteeing this kind of variable. So we don't see that changing for the foreseeable future at the moment.
Well, it certainly seems that that great huge push that we saw in online has sparked off this huge change. It was a change we were already seeing. I said it's been supercharged in recent months, recent years, the last couple of years. Guys, thank you very much indeed for this. I'm going to hand over to Len now.
Thank you, Liza. I just wanted to say a big thank you to our panelists, Kevin, Matthew, Andrea. Of course, Liza for moderating today's webinar. Greatly appreciated, Liza. And a quick thanks to my team, Tim and George, who've been answering all the questions in the background. I hope you found the webinar informative today, and thanks for joining us. All the best.